Well, let's get across markets now. Kyle Rodder joining us from Capital.com. Kyle, welcome back to you. So, a number of developments to get across. Of course, that momentum rally continuing on Wall Street, despite higher than expected producer price inflation, and we've also had confirmation of Kevin Warsh's nomination.
Yeah, it's a bit of a Teflon market at the moment. That higher producer price number largely shrugged off. It has to be said the components that go into the PCE index were relatively well behaved. But if you look at the futures curve, we've got a market now that's, pricing in almost a 50-50 chance that we'll get a rate hike from the US Federal Reserve by the end of the year. And so now this confirmation of Warsh's Fed chair becomes increasingly important and kind of crystallizes, that kind of theme. Will Warsh continue to be as dovish as he was in the lead up to his nomination, or will he sort of revert to his old policy bias of being a real inflation hawk and, sort of shifting effectively his bias towards focusing on that when he becomes Fed chair? But for now, I mean, as you noted, this is a big momentum rally driven by, a strong fundamental catalyst, but a very much a momentum rally at the moment. The fact that we have seen geopolitical risks come back down to a simmer over the last few days helps as well. And it's really like a freight train at the moment when it comes to US tech, and therefore Wall Street just reclaiming, fresh record highs.
Now, also eyes on the summit between President Xi and Trump in Beijing. What do you think the market's expecting there? Clearly, accompanying President Trump, a number of chief executives are looking to try and open up the Chinese market, including Elon Musk and Jensen Huang.
Yeah, it seems to be a pretty significant cohort going over there, or delegation, I suppose. It does sort of show you where the US's priorities are at the moment, which is, more or less, tech dominance, the AI sector, and, more or less trying to ensure that its interests are preserved there when it comes to its relations with China. First of all, I think the markets have welcomed this summit just because it's meant that US military policy and its sort of focus on tensions and the war in the Middle East has been shifted for at least a little while. Trade policy, and it's very unlikely that we're going to see the US make any kind of bold move on that front while it's visiting one of its adversaries' allies. The same thing goes with Iran, which is probably unlikely to want to inflame its relationship with China by doing anything while the US is on a state visit to the country. So that kind of focus towards US and China has, perhaps even ironically, been a good thing for market sentiment. But in the bigger picture, the market's going to be looking for any kind of breakthrough on trade, conciliatory language. It's something that hasn't really driven market action for a little while, US-China trade policy. Of course, there has been a very significant development over the last 3 or 4 months, which is to say that a lot of the tariffs that the United States or the Trump administration has tried to impose on the Chinese have, more or less been slapped down. So it has less leverage now than it did then, and that sort of means that perhaps these talks will be, far less of an impact. But if nothing else, like I said, this is kind of a photo shoot opportunity. It will be interesting to see what US and China relations are like at the moment. Obviously, Trump is one to try and ingratiate himself in these sorts of situations is unlikely to do anything that should really rattle markets. But nevertheless, it's probably a welcome distraction from the war, and another reason why, again, the sort of vacuum that's created has allowed for the momentum to continue to push Wall Street to record highs.
Now, Kyle, locally, clearly still feeling the reverberations of what is a significant budget that was delivered, particularly the tax implications of that. Do you think we're likely to see further moves on the market? I mean, I guess you could argue that CBA dropping more than 10% yesterday, was that in part because of potentially the headwinds that banks now face, courtesy of the property market and these tax arrangements?
It could be. I'm somewhat skeptical, and the results, weren't great. And we're looking at a stock that was already very richly valued, a sector that was already richly valued, and the Australian domestic economy is hardly in a great position at the moment. The implications of the budget may have been felt in certain sectors of the economy. Again, at the margins, maybe the banks. We did see some weakness coming through some of the property names. PEXA was off by 4.5% yesterday as well, for example. Maybe a bit of a proxy there too for activity in the property market in Australia. But for the most part, I think the markets are probably going to take this in stride, and the really big implications of this are going to be quite structural with a long tail, which is to say, what investors' preference in terms of where they invest, especially when it comes to domestically versus sort of international equities, and also the implications of whether there is a preference now for growth companies, income generating assets rather than growth companies. That might be something that, impacts investment decisions and asset allocation decisions going forward as well. But for the most part, I mean, if you look at the budget on the aggregate, fiscal conditions are in a sort of position that is not, say, helping the inflationary backdrop, maybe making it worse slightly at the margins because of the increase in spending, but not a terrible amount. And, from a fiscal standpoint of view, we're in a fairly stable position compared to the rest of the world. So you shouldn't sort of see an impact on bond markets significantly that could impact valuations and things of that nature. So the impact of the budget is sort of marginal at best. I think the banks, again, it's a little bit more about the actual valuation story there, as well as profitability and impairments going forward, or I should say provisions. So I think we'll probably see the impact of the budget really waning now in the short term, albeit again with sort of pockets of pressure at the margins because of, again, some of the behavioural changes that it will create.
And Kyle, if you're looking for income, some of these resource stocks, probably not a bad way to go right now, given where those commodity prices are going, in particular copper going from record to record.
Yes, and I think that perhaps to the relief of a lot of investors in Australia is that we have at least a little small exposure to this, larger sort of thematic here when it comes to the AI trade. And it has to be said, if you do look at copper prices, and you do look at silver and other materials, they have trended in a very strong correlation with US tech, in particular US semis. And since we've had throughout US earnings season this kind of resurgence in the AI trade, so to speak, again, a lot of those kind of critical materials that are going to go into the infrastructure build out and what have you, copper, silver, and so on, have kind of followed that trade higher as well. You throw in there that we had a sort of a resilient Chinese data or Chinese economy, or better than expected Chinese data over the last week or so, and it's provided that kind of very significant tailwind for the copper price, and therefore the Australian miners, which are increasingly becoming a play on copper. So we're sort of deprived domestically of AI opportunities, but indirectly that kind of copper story in our miners are an indirect way to get exposure to that, and so we're sort of benefiting as a sort of secondhand effect of, again, that kind of resurgence AI trade there.